Okay, let's just dive right into this explainer. Today, we're going to demystify the Canadian equipment financing landscape for 2026. Look, whether you're running a construction crew, a bustling restaurant, or maybe a growing medical clinic, you already know the drill. Acquiring that heavy-duty machinery you need without completely draining your working capital, it's absolutely crucial. So we're going to break down exactly how to look past the surface numbers and make the absolute smartest moves for your bottom line.
It really comes down to this universal dilemma that Canadian entrepreneurs and contractors are facing right now. How exactly do you pay for a $250,000 excavator or, say, a $50,000 commercial kitchen setup without crushing your cash flow, right? You absolutely need this expensive gear to generate revenue, but preserving your day-to-day cash for payroll, fuel, materials, that is king. You literally cannot afford to tie up all your liquid cash in a single asset.
So here's our roadmap for today's explainer. 1. The cost of growth. 2. Unmasking the true rate. 3. Lease, loan, or rent. 4. Finding your lender fit. And 5. Government backing and grants. Let's get into it. Section 1. The cost of growth. Why capital preservation is king.
70 to 80%. That is the massive gross profit margin a restaurant operator can make on a properly financed soft-serve ice cream machine. And get this, the payback period is just 6 to 18 months. Think about what that actually means in practice for a second. If you time your acquisition right, a sudden spike in summer foot traffic can easily generate enough daily profit to cover your entire monthly lease payment by like the second or third day of the month. Everything else after that, pure margin. It's a perfect example of why you really shouldn't fear financing. When you finance high-margin equipment, the machine literally pays for itself from the brand new revenue it generates, all while your original cash stays perfectly safe in the bank.
So the main takeaway here is that smart financing ties your equipment acquisitions directly to clear revenue and efficiency goals. It's not just some generic capital purchase. Whether it's a super automatic coffee system pumping out 80% margins for a local cafe, or a new piece of forestry equipment that lets a logging crew take on twice as many contracts in a season, you are strategically leveraging other people's money to fuel your own growth. Moving on to Section 2, Unmasking the True Rate, diving below surface numbers. Let's peel back the layers of this financial iceberg, because I promise you, the sticker rate you see advertised is rarely the whole story. You've got to look past the stated rate and focus completely on the APR, the annual percentage rate. See, the stated rate is just the base interest applied to your principal. But the APR, that reveals the true, unmasked cost of borrowing over the entire life of your term, because it bundles in all those extra hidden fees and costs into one single annualized percentage. Honestly, this is the only number you should ever use when comparing offers. Let me give you an example. Say you're looking at two different offers. Lender A dangles this really attractive 8.5% stated rate. Sounds great, right? But look closer at the fine print. They tack on a $1,200 documentation fee, a $500 admin fee, and an $800 appraisal fee. Ouch. Then consider Lender B. They have a higher stated rate of 9.25%, but zero hidden fees. Once you actually run the math, Lender B's total cost is cheaper. This happens literally all the time in the equipment finance market. Taking rates at face value is just dangerous. So to truly protect your working capital, you've got to watch out for this rapid-fire list of hidden traps. Lenders use these to make their baseline rates look artificially low. You should always ask for an itemized list. Ask them, are there origination fees just to process the paperwork? What about appraisal fees for used iron, broker fees? And definitely ask about strict prepayment penalties. I mean, imagine you land a massive contract and want to pay off the loan early. Some lenders will actually hit you with a 1 to 3% penalty on the remaining balance. Knowing these traps ahead of time is absolutely crucial for accurately calculating your total borrowing cost. Now, if you're looking at a lease instead of a loan, things get kind of tricky. Lessors often quote what's called a lease rate factor, which is just a small decimal. But remember, the lease rate factor is not a standard interest percentage. It basically bundles the interest, term length, and residual value all together into one number. So if you want to make an apples-to-apples comparison with a standard bank loan, you've got to explicitly ask the leasing company for the total of all payments over the term and the equivalent APR. Don't let them dodge that question. Okay, Section 3, Lease, Loan, or Rent, the vehicles of acquisition. So, when you're ready to acquire that equipment, you have three main paths. Bank loans are great if you want immediate ownership from day one, but they typically require strong, established financials and a pretty hefty down payment. Then you have lease-to-own structures.
These are fantastic for preserving cash because they offer low upfront costs and highly predictable fixed payments. Plus, you still get ownership at the end of the term. And rentals? Well, they offer pure flexibility. They're perfect for a short-term menu test, a seasonal construction need, or maybe a brand new startup that just wants to avoid long-term debt altogether while they prove their business model.
Now, if you do go the leasing route, there are two major paths you got to choose between. A $1 buyout lease acts a lot like a traditional loan. Your monthly payments are going to be slightly higher, but at the end of the term, the machine is yours for a single loonie. On the flip side, you have a fair market value lease. This means you're really only financing the asset's depreciation during your term. This gives you the absolute lowest monthly payment possible, but the catch is you don't automatically own it at the end. You can either buy it at whatever the market value is then, return it, or just upgrade to a shiny new model.
Moving to Section 4. Finding your lender fit. Navigating the landscape.
Look, applying to your everyday big-name bank is not always the right first step. Your personal credit tier heavily impacts your borrowing costs depending on the type of lender. If you have excellent credit, say 750 plus, established history, and you're buying brand new equipment, yeah, you could secure rates around 7.5% at traditional banks. But if you have challenge credit, or maybe you're trying to buy a 12-year-old used excavator, your rate can easily jump to 15.5%, or even over 20% with alternative or private lenders. It's a huge spectrum.
As the experts at Iron Finance point out, the biggest error folks make isn't applying for the wrong rate. It's applying in the wrong lender category first. Taking a fair credit file or a request to finance a 15-year-old machine straight to a strict major bank is usually a recipe for a swift rejection. And worse, it results in a wasted hard pull on your credit score, which just drops your rating even further. You really have to match your specific file to the lender type that actually has an appetite for that specific level of risk.
And hey, we really need to bust the myth that a low rate is always better. Hear me out. Let's say you just want a major contract that starts in 2 weeks. An 8% bank loan sounds great, but if it takes them 4 weeks to underwrite it, you lose the job. Simple as that. But if a private lender charges 12% but funds your equipment in 5 days, that speed allows you to start that lucrative contract right on time. In a scenario like that, the higher interest rate easily pays for itself. Sometimes speed is just a feature you have to pay for.
Finally, Section 5, Government Backing and Grants. The hidden treasures.
Let's explore some alternative funding avenues that can protect your capital even further. First up is the Canada Small Business Financing Program, or CSBFP. Guys, this is huge. Basically, the federal government steps in and shares the risk with your lender, which makes them way more likely to say yes. Under this program, eligible businesses can access up to $1.15 million total. But what's really crucial for our conversation today is that up to $500,000 of that can be used specifically for new or used equipment and leasehold improvements. It's just a fantastic framework, especially for startups looking to scale up quickly.
Alternatively, imagine being able to secure 125% of your purchase price. No joke. The Business Development Bank of Canada, or BDC, offers an equipment loan that can actually do this. And why does that matter? Because acquiring equipment isn't just buying the machine itself. You've got shipping, complex installation, weeks of staff training, the list goes on. A BDC loan means those extra out-of-pocket soft costs are fully covered within the financing. Your day-to-day working capital stays completely untouched. That's a game changer.
And definitely don't sleep on local initiatives. For example, if you're an entrepreneur in the Kingston area, local grants like the Starter Company Plus program offer up to $5,000 in non-repayable funds to expand your business. Non-repayable! To get it, you just need to match 25% of the grant with your own personal investment and complete their business boot camp. But honestly, the real hidden treasure here isn't just the money, it's the one-on-one coaching and mentorship you get, which can save you from making massive strategic errors down the line. Programs like this exist all across different regions, and treating them as an upside to your core financing plan is just incredibly smart.
So, armed with the knowledge of how to uncover true APRs, decode lease structures, find the right lender category, and tap into these government grants, I want you to ask yourself, what piece of equipment could absolutely transform your business tomorrow if you just use the right financial leverage to get it today? The tools are out there. Now it's just about making the math work for you. Thanks so much for joining me on this explainer, and I'll catch you on the next one.